Welcome back, everyone, to the European VC podcast. Today, I have my dear friend and co-host of the podcast and our in-house expert on everything CVC, Jeppe Høier. And we are talking to Martin Scherrer, partner and head of managed funds at Redstone, a firm playing a dual role as a classic VC and VC as a service for corporates and family offices as well. Martin brings deep roots in insurtech, fintech, and corporate venture, and today we'll focus on CVC secondaries, how to wind down without burning bridges. And as a side note, of course, given this topic, the recent closure of Munich Re's CVC efforts is very much on our radar and the backdrop of today's conversation.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
So welcome to the podcast, guys.
Thank you.
Hi, Andreas. Hi, Jeppe.
So yeah, but you know so many in this corporate venture landscape, and Martin was one of the guys you really wanted to get on the podcast. So first, maybe you'd say a few words why you think that Martin is the great guest to talk about this today.
I do. It's not the first time we have Redstone on the show, right? We've had Samuli here before. Redstone is one of the funds that I really look up to. I engaged with Redstone for the first time at my time at Merz Growth back in 2018, where they did assist us. So this VC as-a-service thing came in, and that is really interesting for me. The topic for today is one that I have thought a lot about when to bring in. Martin and I, we have been discussing when is the right time to bring this topic in, that is secondaries of CVCs, because I'm here to talk about, everything good about corporate venturing and how to extend the 3.7-year average lifetime. But right now, with the closure of Munich Re, we cannot avoid this. Now we need to have the talk. We have an expert here, Martin, and I'm really, really looking forward to what Martin will bring to all the corporates out there that are listening in.
Martin, I gave a very short intro to Redstone, but to those that don't know Redstone, maybe you can just expand on it a little bit.
So Redstone is a VC asset management platform, I would call it today. We run own funds, but we also run managed funds from corporates, from family offices. But I would say the roots really, my personal roots are coming from CVC. So I started my career at Swiss Re, who wound down its CVC activities already 23 years ago for several reasons. But also Redstone actually emerged as a CVC as-a-service provider in its early days, 10 or 11 years ago, and only much later on evolved into a classic VC. So we have worked with more than 80 corporates over the past 10 years. I think we know pretty well how to navigate their world, to understand how they operate, how they take decisions, how they define innovation, and how they look at strategic benefits. So we bring, I would say, the CVC and the VC perspective in, but also the founder perspective, as many amongst us, including myself, I had an insurtech here in Switzerland that I founded or co-founded and then exited. So a lot of us amongst us have, founder experience, which I think this threefold of VC, corporate VC and founder background, puts us in a pretty nice position to work with corporates and help them present themselves towards startups and co-investors in a way that they are being welcomed on the stage.
Can you share a little bit about the benefit of being in both worlds? Behaving as a VC, but then also have these managed funds?
In the end, it's both about investing into innovation, seeing some disruptions happening out there, supporting those. You do it with a different approach since, when you work with a corporate, the original idea is, we don't want to make financial returns. Sometimes they explicitly say we don't want to have any financial KPIs, and we first need to persuade them that this is actually really important, but they do it because they want to have strategic benefits. Of course, that's not the case when you have an LP just investing in your VC fund. In the end, what do you do is the same things. I think you source the capital from get the capital from a different source, and you have a different filter when you look at potential investment opportunities.
I think you make a very good point when you talk about the importance of this setup and the fact that corporates need to understand that VCs have optimized startup investing over decades, and there's a lot to be learned from that. Could you just talk about the importance there and what that means specifically when it comes to the setup and the processes that you run?
I mean, one myth out there is, and we also hear that, ever again from corporates, that, investing in startups it's not so difficult. Everyone knows an angel who invests in startups. Maybe, someone is investing himself. The magic behind it in the end is not only to make an investment, as we all know. It's about, working with setting up a portfolio, working with the portfolio companies, making great exits. And that takes a lot, in order to get into that position. You need to think about a portfolio. That's something that corporates, usually don't really want to think about. They rather say, like, let's start with 1 or 2 or 3 investments and then let's see then where that takes us. And, when you revise, your strategy after 3 years, we all know about the J curve, and we know it's probably the worst moment in time to, to think about, is this a good thing, what we're doing? So you really need to commit to an investment strategy, to the buildup of a portfolio at the very beginning. You need to have financial returns as your goal on top of your strategic goals that you have, because otherwise you are in the market immediately being viewed as someone who's not really caring about valuations, and that's not someone a co-investor wants to be on the same cap table with.
What is really interesting here, right? Because also when I refer back to the book called The Venture Mindset by Ilyas Strebolev, right? One of the things in corporate life is this portfolio thinking. They don't have it, right? So it's like if you have already invested $100 million into an initiative, right? You're not going to be willing to close it down, right? Venture capitalist knows the high risk of building a portfolio and closing down things that do not work, right? So it's just a pure mindset thing here that is a challenge when we go through this.
And regarding the financial, aspect of investing, we are always the ones, sometimes saying, this is an investment that is really interesting from a financial perspective. And we have many situations where a corporate said, yeah, but, it's not strategic enough for us, so we'd rather pass on this. There's one fund, health fund that we will build up where, in the meantime, one of those financial investments that was not so close to the core of the insurer, it looks like this is now going to be the fund returner for them. And what that means is that, the expectations on all the other investments are not as high anymore because you already have your capital paid back, and, you're not being questioned year by year, what are you doing? Why are you burning so much capital?
I'd love us to go, because we all know runoff processes are super delicate and super important to get right. And you've helped the SCORE team and have a very important case study there on how you at Redstone managed a full portfolio transition after SCORE decided to stop their new investments. I'd love to hear more about the key steps that you took in that process and what lessons can be learned by other corporates.
After SCORE took the decision to exit this, there's always the question, how do you close this down? How do you wind it up? And obviously there's the opportunity to sell the portfolio as a whole or in pieces to a secondary buyer. That's the quick and dirty solution, so you can get it quickly off your table. The thing is that a secondary buyer, himself wants to get a 2 to 4x on his fund. So therefore you will have to take a really painful cut on your net asset value, which, comes typically at a 50 to 80% discount. And so first you need to think, do you want to go that route? Or as SCORE decided, before we were involved, they said, we want to get as much out of it as possible. We don't have any rush in getting back liquidity. We want to maximize value. We want to gradually reduce risk and generate liquidity. I think unless you have a meaningless or a bad portfolio, is definitely the best decision. And then the first question is, who does the runoff? Do you want to do that with an internal team? Do you want to go with an external team? The existing team is typically a bit of a stretch because, if you put yourself in their shoes, they're very surprised about the decision. They're obviously not very excited about that decision when investments all of a sudden come to a halt. I think there's also, for natural reasons, some frustration in there. Some, particularly insurers, they have their asset management function where you typically have people focused on private equity investments. Having said that, they typically invest in funds and they're not used to deal with individual companies, and also they have different priorities. So in this case, and SCOR was advised by a big four, they took the decision to go with an external specialist who's experienced in managing such situations, who knows how to create value on boards, how to work with co-investors. And we actually have another case, which is Helen Energy portfolio. We also took over the Helen Ventures portfolio. We also took over this year after very similar situations. And there we actually took over, 3 members of their team, which for them was actually, a pretty good move, because otherwise, what would have they be doing? They probably would have been laid off. And now they are with us. They're in an organization where even after Helen Ventures is being divested completely, they have new career opportunities within our VC operation.
And Martin, there's one thing that comes into mind as you go through all the corporates you have been in dialogue with. Some of them are your customers today and so forth, right? And also tying back to your CVC background. There's a lot of CVCs that dream about spinning out anyway, that is kind of the future and what they need to do, because they see the VC world and what that also has of positive elements. But as you go through this, is that a why aren't they spinning it outright when they want to close it down? Well, what comes to mind in these processes? What are the learnings from your side?
Spinning out a fund at an early stage is something that can work, or when you put up a second generation fund before you start investing. So you basically commit the corporate's own capital and you onboard third-party capital from other, potentially also strategic investors from the same sector, or purely financial investors. But once you have built up, a huge portfolio, that becomes pretty challenging, if you only think about how to value, that portfolio for the new investor joining the round. It is definitely a good strategy, I believe. Swisscom Ventures, for instance, in Switzerland has shown that in their recent fund, they have onboarded external capital, and that obviously makes it is a very strong, resilient strategy to protect your CVC from being shut down. And maybe one example, we have first advised Berliner Volksbank to set up their first fintech CVC about 8 years ago, I think it was. And we worked with them as a VC as-a-service provider. Then the second fund generation, they opened up to other Volksbanken and Raiffeisenbanken. There was also an insurer investing into it. So it was now a open LP structure, still with with strategic benefits for the LPs. And now the third generation is Redstone Fintech III fund. The team again here from Berliner Volksbank has moved to Redstone, and now it's a typical VC fund, still with some strategic benefits for those banks as LPs.
Now they have decided to close it down, right? So let's imagine that's that situation, right? What is the divestment strategy that you then go in with, right? Because they want to get out. How do you handle that?
We've first obviously had to onboard the portfolios. In SCOR's case, it took us about 3 weeks to onboard 25 portfolio companies. So we had no interaction with the previous team, so we had to read through everything we had. We were shared, by SCOR. That was a pretty challenge. And then, of course, once you speak to those 25 founders, many of them have, big topics, big requests, things that have been waiting, new financing rounds they want to work on. So you have to get your arms around which are the big exposures, where are the critical topics at the moment, which of the cases, maybe can you just put aside for the moment. Obviously, where are the board positions that you need to take over, who within Redstone is the best suited person with the background that can support that company. Then we typically do a scenario analysis. So we identify for each and every portfolio company 3 scenarios. A, what would happen if we would try to sell that company ASAP? What's the value we could get out of that? Second scenario is, what could we expect if we sell the stake, at the next financing round as part of a secondary? That's typical scenario B. And scenario C is, what can we expect if we hold until the company itself exits? And then that's basically the starting point. And then obviously, there are different options that arise. All of a sudden, you have a co-investor who asks whether he can increase, buy some shares from you in order to increase his stake. And then obviously that also plays a role,
Actually, in what you said, right? So if we imagine option C, right, that you hold it, right? So in a downsizing and letting everything go scenario, do these corporates actually also give you more capital for follow-on investments, or how does it go?
Yeah, that's a very good point, and it is very important, I think. So yes, actually in all the cases where we manage funds from corporates that are phasing out, we have the opportunity to make follow-on investments. Why is that so important? Because it sounds a bit counterintuitive if, a corporate says we want to stop investing in VC. There are 2 typical scenarios. One is a company, and we just recently had such a situation, a company hanging between seed and Series A. They lagged behind their plan. They were not able to raise from external investors. That corporate was their only institutional investor, so all of the founders' eyes were just looking into the direction of that corporate. Please, we need more capital. Otherwise, no one's going to give us more money. We persuaded the corporate to put in it was a very small amount, so a few $100,000, and that led to some angels follow on to that round that made it bigger. It gave them a longer runway, and after that longer runway, at the end of that runway, they managed also with our support to get on board 2 really great new VCs, and that made them pretty independent now, of that corporate.
So that's also, that's a beautiful situation, I think, to get there, right? But I also know how hard it is to get money out from a big corporate, right? Could you talk a little bit about it? What does a successful partnership look like between Redstone and a corporate client?
You have to set clear expectations, or at the core, you have to talk with the corporate. What are your expectations? What are your goals? You have to define competencies, that we have, decision rights. You have to define an interaction model. You have to define, what are their expectations with respect to reporting. Score, for instance, publicly listed company needs to report based on IFRS 9 standards, and we need to be able to provide that. And for all of that, you should formalize that in an operating manual, so it's clear to everyone who can and is allowed to do what and how do we interact. Second thing, I believe it's important to have a financial alignment, also, a performance-based structure where both sides win, when the portfolio performs and when we can do great exits. And when you think about the investment strategy, when it comes to building up a portfolio, you need to have alignment and buy-in from the corporate that you're allowed to do financial bets, as I explained before. And when it's about phasing out the portfolio, so that then we call it a divestment strategy. If you talk about we want to maximize value, you need to acknowledge that you cannot sell quickly. Or you may even need to invest further, or when you want to reduce big exposure, it means you cannot sell at the best price. So it's important to talk about that and to have a common understanding, a balance about reducing risk, generating liquidity, keeping an upside, and then strictly adhere to that.
Redstone both does corporate venturing / corporate clienting, however, not corporate clienting, but the CVC as a service model. But you're at the same time also have corporate LPs, and there's a bunch of VCs that have corporate LPs or want corporate LPs. Maybe you can talk a bit about when is it right to have a corporate LP? When should you as a VC think twice about whether you can actually service them as they expect as an LP? And to put it differently also, and when should you realize that this is almost a corporate CVC as a service model?
Well, I mean, as long as you have a corporate as an LP on a standard VC fund, where you have many LPs, you don't really have to, think about, because they enter a same limited partnership agreement than all the other investors. Yeah. And I mean, obviously you can service them with you can provide them additional services that are, that help them, take strategic benefit out of this investment. But based on that limited partnership agreement, you would never be allowed to invest into startups that are only strategic relevant to that LP. Yeah? The issue is only, as soon as you have a single LP, a corporate being a single LP, then obviously that's a completely different game. And that's when we call it's a CVC structure, because obviously the corporate can at any point in time, decide to stop this. What we try to do there is, to make sure that we have a balanced IC, not only purely people from the business side, from the corporate, but only a partner from Redstone that brings in the pure VC perspective. Maybe an industry expert who is independent, but with also some VC background. Yeah, and then it's a different way to serve them, because in the end, they're also a client. They're an investor, but they are also a client that they expect some output on top of the financial performance.
I ask you the question because I'm sure that you, with the reputation Redstone has in the ecosystem, are asked by many peers in the venture ecosystem, how do you manage corporate? So how do you make sure that the relationship is truly good and beneficial for both sides, that you don't overpromise? And maybe you could talk a bit about the red flags and the things you tend to say to VCs that are thinking of corporates as LPs.
I think oftentimes when a corporate, they decide to do a fund-of-fund investment, it's setting up, what is the expectations? What does a corporate expect to get out of it, right? Because they expect more than just putting money in and get a financial return, right? Otherwise, they wouldn't do it. So I think for me, it's setting expectations around, will they participate in deal sourcing? Can the corporate get access to invest into portfolio companies? Should the startup decide so? And so forth, right? So I think it's those elements, and going back to what Martin also put on the plate before, right? It's goal and mindset alignment. It's like, what is this, right?
One important point, and this is also something we discuss with the corporate at the very beginning, is, what's your expectation with respect to strategic benefit? And once someone says, well, for instance, we have an issue with our, CRM or whatever, any technical, pain point they have. And this is, for instance, something where we would, like to get a solution. And we think we could get that through VC investing, through a startup. And I say, no, VC is not about working on pain points. Yeah. If you have a specific technical challenge that you need to solve, there may be 10 startups out there that can solve that issue for you. And we might potentially be able to find it through CVC. But there may be, huge companies, the SAPs, Oracles of this world, Microsoft, whomever, who might be the better fit for you. So don't use CVC to work on your pain points. Use CVC to get an outside in view, to see what's happening out there. Where does the money flow to? Where are the best serial founders putting their time and resources into, which might potentially even disrupt your business or help you, move into a new business line or make your business more efficient.
And in corporate venturing, right, Martin, also, right, we need to cover, to have the full strategy for me, right, the build, partner, invest framework, because it's all elements that you need, right? There's no corporate that should just take the one or the other, right? Also ties a little bit back to portfolio thinking. Martin, I would like to ask you, so when you then take over, right, how does these startup founders and your co-investors react, right? When you come in there and say, now it's me, Martin, sitting on the board, assisting you on the future.
It's very, very different. I think, first of all, there's disappointment when they hear about the decision of the corporate to reduce or wind down its CVC investment activities. We have this investor on our cap table, probably will not get any support for follow-on rounds. There's debt capital on the cap table. We will probably not get any support on the board anymore. What's happening? Who's our contact person? And as soon as we have taken over, the reaction is probably usually a very different one, very positive one, because they realize, it's actually someone with a VC background, which is, great for us. Someone with experience on working on boards, providing value to the companies, maybe even someone with a specific sector expertise. And with a co-investor network, that's pretty important, particularly when you have someone on the cap table leaving. You want to make sure, maybe you need, the backing of new investors where we can make interest too. And as soon as they hear, that there's still the option to make follow-on investments, they're actually pretty relaxed and happy. And it's also the chance for them, to have a new and fresh set of eyes on the board, giving them, new inputs. But also expect to have some co-investors, some founders who want to test your limits and see whether, you're maybe interested to still sell quickly at a cheaper price, and for them to, to take the option to profit from that.
I just realized we spoke about the topic, the title of today's episode is CVC secondaries, and we've spoken about a bunch of the processes of doing so and how to manage it and so on. If we just should touch a small second on how are these deals structured? Normally we think of secondaries as you buy a portfolio at some value and then you own it afterwards. Here we've also talked about, sometimes it's a consulting agreement, so to say, because you take over the management, but you don't necessarily take over the ownership portfolio. So can you talk a bit about that? When do you go on the one side? What are the usual deal terms? What makes it clear that one is the right decision versus the other?
Up to now, we're not a secondary buyer. Yeah, there are many specialist secondary VCs who buy entire portfolios in such situations. What we do here is we take over the management from the portfolio from the existing team. The only difference is that we are external, and the difference is that we now have a different goal, which, sometimes is not even that much different. I mean, yes, you make no new investments into new companies, and you accelerate the exit a bit. Based on that, every situation is different. It obviously differs whether a fund is pretty early in its lifetime or already pretty late in its lifetime. Obviously, there's a management fee component for the costs involved on our end. And then also, typically we get a carry or we agree on a carry with the corporate just to make sure we have full alignment on the outcome.
Even so, Martin, I'm sure that the corporate will have made the decision. Do we try and go out and sell, or do we try and go out and get it managed? And I'm sure that you've been propositioned also with the opportunity to buy portfolios outright. And so far, you've decided not to run that model. Can you talk a bit about typically what you say to a corporate when they proposition that you buy their portfolio, and also why you yourselves so far have decided not to run that model?
I think it's just a very different focus, and I'm not saying we as Redstone are not considering this in the future. I mean, in this, in the cases that we described or we talked about, like Score like Helen Energy and others. It's basically that was the decision from the corporate to go that route, and based on a recommendation of their consultants, because they didn't want to give away that big part of the upside. Yeah. And I think that absolutely makes sense for the corporate. And from our end, I mean, for us, I've been working with corporates over many, many years. I know how they function. I think we can offer the tools for the entire value chain of CVC, from setting up structures, making investments, running portfolios, and exiting entire portfolios. And that's what this is based on, and what we are specialized to do.
I think also for me, reflecting on it, right? So when you as a corporate decide that it's time to leave the venture space, does it then make sense to sell it all in one of these 60, 70, 80% discounts on the whole portfolio? Of course, you then get rid of the problem. You're gone with all your OPEX and everything is nice and bad, right? But what I really think you should consider as a corporate, right, is that in this situation where you were to hand it over to Redstone, what you actually handed over to is a group of specialist investors that are used to handling startups, right? Because if you hand it over to a consultant with the only mindset of winding down, then I actually think you get less value out of your assets. So in that whole perspective, I think for me it makes sense to go to partners like Redstone in such situations.
Also for us, being working with corporates on CVC, I mean, obviously, we built our services based on the fact that we want to help corporates set up new CVCs and help them manage them and bring them to a success from a financial and a strategic point of view. But, it's not negligible, looking out there, what's happening out there in the market, that you have corporates leaving the stage, and this will never change. There's a big discrepancy between, the short-term goals of managers and the long-term horizon you need to be able to look at when you invest into startups. It's natural they come and go. They make up for such a big part of startup investments that we just need to make sure that corporates, when they invest and when they leave the stage again, that this is handled in the most professional way possible, both for the financial benefit and the reputation of the corporate, but also for the startups and the entire ecosystem.
Martin, one of the things that I'm eager, the question that I'm eager to pop to you is also, what is it that we're lacking? Why is it that corporates get to the decision of a close down, right? So I think my dream, right, I have this 3.7 year average lifetime, right? It really hurts my soul, right? That's the cancer I'm fighting. Then I'm up against two things, or we in the ecosystem are up against two things: people and strategy change in corporate lives. So we have new decision makers coming in. And, in EUVC corporate, one of the things that I dream of is to bring the VC and the CVC space closer together, so we will not have this discussion in 15 years, right? Why that happened. Could I get your perspective on why is it that senior leaders, when they take over or whatever and do these decisions, what is it that is missing in the equation?
There are so many different reasons for corporates to leave VC. I mean, back to my own experience 23 years ago, Swiss Re, why did we had a team of more than 60 people. It was huge. The closure of the VC unit happened 2 years after the internet bubble burst. So performance was an issue. And it happened 1 year after 9/11, after which, Swiss Re completely, focused on the, emerging opportunities in their core business. So these are, I think, those are two typical situations. Having said that, poor performance, is typically an issue early stage in a fund, unless, the investments have really been made in another very, very professional way, or you haven't built up a proper portfolio. And if you then have a new CEO coming into the company, or a new, president of the board of directors, you have other issues that are on top of their minds, in combination with a lack of mindset for VC, then it doesn't take much, to just close that down. I mean, Helvetia recently, Munich Re, you mentioned it. I think Munich Re is far away from struggling in their core. I think it's quite the opposite. I struggle a bit to understand.
They also bought parts of the portfolio, right, in huge exits, right?
Yeah. So I'm really curious to understand the reasoning there. But it happens, and the big question really is, at this point in time, for a CEO to pop up and say, well, we're starting as a new CVC unit, it takes quite a bit when you see all those other big players, leaving the stage. Why should I be, exposing myself now? And there are new players, which is, fantastic. I also ask myself the question, what needs to change that in a next CVC upswing cycle, we get to a stage which is, more resilient. Do we have more? Are we able to set up more structures that are more resilient towards such situations?
No, I think it's interesting, right? Because one of my own kind of, pain points that I see is around this, is C-suite in Europe well enough educated to understand what is corporate venturing? When you look at our US counterparts, right? A lot of the big companies, they used to be startups, right? We don't have that in Europe, right? In Denmark, we have not had a, company coming in on the major stock exchange for almost 25 years, right? It's legacy, all of it.
Yeah, it's yeah. And I think it's also really the time horizon that a manager has, it's not 7 years, it's not 10 years or 12 years. We've recently seen a situation where a pretty strategic investment from a corporate, where it was clear that company will not make it further, and they entered into a huge merger with another company. It cost another, some more money, gave that investment more runway. Seems like that whole thing is now collapsing. And, how could that corporate have agreed to such a merger? And it ended up like, that the CEO had to leave anyway, but like that, was able to not to get a setback on his bonus before he leaves. It's a reality. It's a reality that you have different incentives, different time horizons, and it's difficult to get that, laid across.
Gentlemen, we only have 5 minutes left. I almost want to go back to an opening question we could have asked as well, and something that we spoke about off the air before starting as well, which was, how do you best avoid a wind down when you set up a CVC? What are the steps that you need to take? We all know alignment. We all know the importance of making sure that the corporate executive team understands the dynamics of venture and so on and so forth. But are there specific things you can do in an LPA, or you can do from a setup perspective, that allow you to protect the entity, that corporate CVCs or VCs that come in to lead us as CVC should maybe think about bringing in?
I think the gold standard here is really to have a third-party LP capital, because that technically, almost makes it impossible for the corporate to just stop, his commitments. That is usually very difficult, because the corporate, he does it for strategic reasons. He wants to control it, and he doesn't want to share it with anyone else. But it's, that's the gold standard, I think. Then I think there are a couple of things. You should definitely not do it from your annual budget. Say, we use 6 million from our annual budget to invest into startups. When you do that and you have a bad year, then all of a sudden, that's being questioned. The best thing is if you have a separate legal entity put up, that is actually has the pot of cash on that balance sheet. You can have a clear investment strategy. You have a portfolio approach, and you involve the decision makers on a regular basis. I think a good thing is if you have one sponsor at least, from the executive board who is a part of your investment committee, for instance, and just make sure to keep that relationships, very, very open and have regular interactions.
And I think then it's also, I think when you set up your CVC, make sure to get somebody from the outside world that understand what is venture capital, right? Because we are, Martin, you mentioned the hockey stick early on. 3.7 year average lifetime, you are down. You are below index 1 on your portfolio at that point of time. So you're closed down for financial reasons, right? If you survive that, you hit the next wave. That is the close down for strategic relevance, right? You have invested in a portfolio that all of a sudden is no longer relevant for the company, right? And then I think, year 9 is kind of where you make it or break it, right? That's where you get more money and so forth, because you have shown you can do and get through 1 or 2, right? So for me, when you start up, right, it's all about internal strategic alignment. To the outside world, you have to be a awesome financial investor. No doubt about it. So you need both worlds, in my opinion.
And we ended with a swear word. Thank you so much, guys, for joining on the podcast. That was the first swear word in the podcast. I think it's almost the first time that it only falls in the last minute.
That's a lie.
Thank you so much for joining me on the podcast today.
Thank you very much.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.